Viewers, thank you for keeping tuned at Smart 24. My name is Anthony Sebale and I'm your host for Financial Markets. And now I promised later in the day we are going to be having someone from ICEA, and I'm glad to present Mr. OWEN KATO, who is from the insurance company of East Africa, as we know it, ICEA, and he is here to give us a little bit more insight into the money market fund. Mr. OWEN, you're most welcome.
Thank you very much, Anthony. I'm glad to be here. Good afternoon, viewers. My name is OWEN KATO, as Anthony has introduced me, and I represent ICEA Asset Management.
Wow, good. Now, let's start with ICEA itself. But even before ICEA, we were talking before when you just came in, that the saving culture of Ugandans is very poor. Like we saw on this show, Ugandans are not good savers. And it's evident all over the place. Even the quickest example I can give is COVID-19. When the pandemic came, everyone was in panic. No one had anything. No one had prepared anything. Why is this saving culture still very poor in Uganda?
Yes, Anthony, that's a very, very sensitive thing. In fact, if you look around regionally, Uganda, I would say, has the lowest savings per GDP ratio. Last I checked was about 13,
13, yes.
Thereabout. And really people have reasons as to why their saving is low. I think one of the reasons is because of the lack of confidence, first of all, in the financial institutions. Many people are afraid. I remember there's a time we had a wave of closures of many commercial banks and different matters. So some people lost money, quite frankly. Those that were saving in the commercial banks, and for some reason they opted not to, to either keep their money at home or not keep it at all. But I also have another reason that I would think people are not saving that much, and it's for reasons of the cost of living. Because someone will tell you that the cost of living is high, and for that matter, there's nothing left to spend, to save anyway. So I would say that because people are not taking care of their expenditure, they are not keeping track of their expenditure, many times at the end of the day you find that your saving is wiped out, what you would have saved is wiped out. But I also want to think that that's somehow an excuse. On the contrary.
Yes.
Because there's a book, The Richest Man in Babylon, it talks about paying yourself first. We are like conduits. You work at the end of the day, get something, and you blow it away. The basic to saving is paying yourself first. You know, if I get 10,000 shillings every day out of my border, I need to pay myself first before I pay the other people. You know, the Muchomo people, you know, the rent and the fuel and all that stuff that goes in there. If you say I've got 10,000, you're getting say 3,000, and that is paying yourself, and paying yourself by way of saving it. You know, then the rest of the money you can be able to pay the other people.
Yes.
That will help us a lot to make sure that at the end of the day we have something that we have kept. And maybe probably people need to know why they save. It's very important to know why one would want to save in the first place. Because if you don't have an ambition or a goal, the reason that drives you to save, then you will not save. You know, people save for different reasons. For emergencies, you know, there are those rainy days when you lose a job, when you fall sick, you know, you need to have something set aside that will be able to meet that need. You might need to procure a property, for example, so you save up for that asset. You might want to do a wedding, for example. You start to save up for that. If you have something in mind, the reason for which you save, then that will drive you to be able to do the kind of saving that is required. The other thing is because of the charges that are associated, because with the saving institutions. If someone gets 10,000 every day, and at the end of the month they have 300,000 and they want to put on an account to save. There are these charges that come on a monthly. And you find that if someone is saving so little and he gets to see that this money keeps reducing instead of increasing, they'd rather keep that money elsewhere or do something else with it. Because they are actually, in their mind, the perception that they're throwing away the money.
Yeah, it's dormant, idle money.
It's idle money. And things like that. Access to financial institutions. You know, people have the money, but they don't know where to save it. You find them put, and you know, money is tempting. If you have it at your disposal, it's very easy to blow it away, to save it. You know, so you not save. So that proximity, the access to the financial institutions would go a long way in helping people to save, but also not leaving behind financial literacy.
Yes.
It's very important to educate the people. People have the money, but they don't know where and how to save.
Yeah.
Yes.
Now, let's talk a little bit about ICEA. ICEA, you said now it has acquired the name Lion as well.
Oh, yeah.
But now people know ICEA mostly as an insurance company. Let's talk a little bit about what ICEA in general does.
Yes. ICEA is a group. Is a group of companies.
Okay.
And in Uganda, it's really known as insurance because probably that's what has been predominant. And it's more than 20 years now since ICEA came to Uganda. But we are older in the region where we come from, in Nairobi. We go as far as close to 2 decades.
Wow.
You know. So, but here we know it as insurance probably because it's insurance that was speaking out most. And we do have ICEA Lion, life insurance. We do have ICEA Lion General and ICEA Lion Asset Management.
Okay.
You know, so the first two are insurance, but the third is in investment, fund management to be precise.
Yes.
So that's where the distinction is. So we are a group, we are a subsidiary of the First Charter Securities. It is a large holding group with interest in banking, manufacturing, agriculture, services and the like. And some of the members of the First Charter Securities are Chloride Group, we do have Mutual Courts, we do have NCBA Bank, we do have NAS Airport Services, and many more. Yeah.
Now let's talk about your docket, where you come from.
Yeah.
What is the ICEA Lion Asset Management Group?
Thank you, Anthony. ICEA Lion Asset Management was incorporated about 18 years ago. That is 17th March 2004. And we are incorporated in Uganda, but we have a holding. The way of our structure is that we do have a holding from Uganda. ICEA Lion Lion Life has a stake, 25%. We do have ICEA Lion Asset Management in Kenya, 25%, and also ICEA Lion Life Assurance in Kenya, taking up the 50%. So we are incorporated with that structure, and we are licensed. We are regulated by the Capital Markets Authority here in Uganda, and the Uganda Retirement Benefits Regulatory Authority, UBRA, to provide professional fund management services. Yes. Part of our goal, or what we look at our vision, is basically to be the Pan-African financial institution with the vision of preserving, first of all, the wealth, preserving and creating wealth for our investors. Yes.
Now let's look now a little bit more into the asset management and how it differs from life assurance or insurance, like you said, and the general property, like general property. What are some of the unique aspects of the asset management? If someone hears asset management, what are some of those things that should stand out?
What we should know is that asset management specifically deals with investment. We are the investment arm of the group. And what we do in terms of investment is we do have a wide array of clients, which clients whose funds manage. We do manage the insurance funds themselves.
So you also, besides you can get the insurance funds and manage them as well?
Yes, very well.
Interesting.
Insurance funds, we do manage that. We do manage unit trust. We do have a unit trust. We manage unit trust funds. We manage pension funds, different pension funds. Both those are segregated and the umbrella. They are different. The umbrella is a cluster and the segregated as standalones. We do manage that, and we also do manage private wealth for those individuals that are high net worth. They have their money and they want it to be managed separately. We do manage that, and probably for the sake of our viewer out there, when I say management here, I mean to grow the money in simple terms. We get that money and put it in ventures, regulated ventures, by the way, that will be able to generate a decent return for our investors at the end of the day. Yes.
Let's talk about the pension funds. For someone to start, investing using their pension funds, do they approach ICEA as an individual, or they go through a scheme like NSSF or a retirement scheme of a company, or you have a plan for them?
That's a very good question. So when you say retirement, we do have people that are still in employment. You're still employed, and your company has a contribution that it makes for you, and you top up. So that money is set aside. You might have, if it's a big company or an old company that's been in existence for quite some time, they will have that separate as a standalone. That's what I call segregated. I'll give an example of, say, Stanbic Bank. That all their staff contribute a certain portion, and the employer tops up, and that money is set aside for the retirement. When these staff retire, that money is then paid out to them when they retire or when they change jobs. So as they set that money aside, it's given to a fund manager, who then grows it to see that it does not lie idle. That's for those that are still in employment. But I do also have a situation where someone has retired, for example, or someone has accessed their funds, like the current midterm access of their funds. So for
20%?
Yeah,
at
40%, 40. 5 if you save for 40 or 10 years. Then for such category, they already have the cash at their disposal. Some are midway into retirement, into retirement, and others have actually retired. So for those that have retired and those that have access to the midterm finances, their savings, when they bring this money to us, we do have what we call a unit trust, for example, as one of the alternatives. So they'll bring that money and we invest it in a unit trust. Alternatively, they will bring it and put it on an umbrella. It's called an individual umbrella product, where they lock it in for 2 years, for example, and they access it only at that time. But as if it's invested in a unit trust, then they have the liberty of accessing it whenever they want, but making sure that it earns them something. Yes. Matter of fact, it's very important that to note that you can actually live off the unit trust. That as you access this money, even before you have something to do with it, don't keep it under the pillow, or just in the bank. Bring it, invest it in a unit trust, and you could start to earn off on a monthly, because as the interest comes, you have the liberty to either leave it there to reinvest it, or to access that interest while the principal remains intact. Yes, so that's the beauty of it.
So you can actually withdraw your interest and leave the principal to still make more interest.
Absolutely.
And I'm told the interest compounds.
The interest compounds. I don't know, probably you preempt me to talk about the unit trust later, but to answer you directly in terms of the pensions, that is the kind of subject that would be one that's retired or one that's into the retirement.
Now let's look at the insurance funds. You also said you use the insurance. People are so skeptical when it comes to getting themselves insured. Let me say insuring their vehicles. Of course now, because it's a must, when you're driving in Kampala, they will check whether you have a third party and so on and all this. But people still have that fear of insurance really, and the stringent measures you have to go through so that they know, okay, they can knock in on the left, but in our insurance policy, we agreed that it has to knock on the left, and then you don't get your funds. How is that working out for you as ICEA?
I'll tell you one thing for sure, and probably many people think that insurance, procuring a policy is throwing away money. But it's until that day when you have actually the situation, when you're hit by the situation, that you come to realize,
oh, I needed this.
I really needed it. I'll give you a good example of comprehensive insurance. Comprehensive is only about, I think, 4% of the value of your vehicle. So it's a small amount. It's a small amount.
What do you mean the value? Like the price of the car?
Yeah, the price of the car.
If I bought at 24 million, 4% of that
About.
is comprehensive.
Yeah, about.
Okay.
So you notice that what you pay for the policy is a small amount compared to actually, if you put it in context, what you would spend throughout the year if you were to fix that car and if you were to actually compensate anyone who's involved in an accident. That's your fault. I'll give you a good example. Many people, and the beauty of comprehensive, you're driving, you don't know what happens, and an accident for some reason when you bash a Mercedes.
Yes.
A Mercedes.
Yes.
You're driving with the Vitz.
Okay.
What happens? What do? You run away.
You leave the VTs behind.
Now that's where the comprehensive policy kicks in. So you don't have to worry about anything. At that point, you only have to contact the insurer and then you can take care of all the damages and whatever is supposed to be taken care of.
Just like that.
Just like that.
For both of you.
For both of you.
Wow.
You know.
Wow.
But if you were the other way around and you said, no, this 1 million I'm just throwing away, my dear, you might have to run away as the option.
Yes. So okay, now back to the other issue of insurance funds. So these people who bring these 4% and so on, you still use that money to invest in these assets. Is that what you're saying by saying insurance funds are also part of asset management?
Yeah, what I mean by insurance funds, because you see, insurance has so many policies, and some policies actually do accrue interest. They have interest that is, that accrues out of, but you don't just, if it's an education policy, for example, you don't just keep depositing money and that's it. You find that at some point they will give you something for your deposit.
Yes.
You have the investor plus policy. But as you keep saving, depositing your money there, there's a portion that comes to you by way of interest. So, because insurance's core is not investment, they have to invest that money with a professional. So they'll get that money and put it somewhere where it can generate the kind of return that they'll give to the policy.
Oh, okay.
Yes.
No, that's great.
Yes.
Now let's go down to the unit trust. In your perspective, what is a unit trust?
A unit trust, in my view, is a basket. It's a pool of funds. So we do have investors, investor A, investor B, investor C, that bring their money together. And when they bring this money together, it is invested in interest-bearing assets. So that at the end of the day, the investments that they have done bring an interest, in simple terms. So that interest that accrues out of those investments is then distributed equally amongst the subscribers or the unit holders, if you would call them in the technical way. Yes. So in simple terms, it's a pool. It's a pool of funds that are invested in interest-bearing assets that accrue interest on a daily, and that which interest is distributed to the unit holders or the investors that subscribe to that pool on a monthly basis.
Is it different from a money market fund and the collective investment scheme?
Actually, unit trust is a collective investment scheme, and the money market is just one of, or say the products, if I could say, one of the products under the unit trust. Because unit trust would have a money market, and you will have a fixed income. It depends on the tenor. Money market talks about the tenor is shorter, near cash, money that you can access as and when. That's why it's called a money market. And the kind of instruments that you invest in are not the long-term instruments, but those that can be liquidated much easily for you to access in the short term. It's a unit trust, but a money market by way of the product feature. Then we do have a fixed income, for example.
Now you're talking about the products already. Okay.
Under the unit trust. Fixed income is more long-term in nature. And this is for people who want to keep their money in there. They don't want to touch it, to access it so easily. This is priced, so it's a bit risky, but it gives you a higher return. Yes.
And over a long time.
So, but more specifically, people are more interested in the money market. In the money market because
they always want to access their money.
They will always want to access, and it's a bit very flexible, if I should say, because many times people have the running account. You have a gig here and there, and for some reason you need money. You need to access the cash to close that deal so that you get more. So liquidity is very important for us as fund managers, that when this person comes, they can be able to access that money, take it away, do whatever they're doing, and then bring it back. Yeah. So that's the beauty of a money market.
We're going into a break, but before going into the break, I wanted you to clarify more on the products you have for customers at ICEA. You've talked about the money market. Talk about more of the fixed income now. Like, who is viable for to buy these products? Who is it? Only people who are insured with ICEA? Is it the general public or institutions? Yes.
That's a good one, Anthony. The products that we have at ICEA as alternatives for investment, we do have, for example, the unit trust. Unit trust themselves. And I've talked about the money market as one that one can invest in and get their money as and when they need it. You can get it the same day, but also accrue interest on a daily. We do have a fixed income fund. Fixed income fund is more long-term in nature. You want to save your money for, say, 3, 4, 5 years. It gives you a higher return, but you have to stay in there without accessing the funds for quite some time. You know, there are people like that who don't want to touch the money. We do have an umbrella. Umbrella is we have the umbrella corporate. This is for the pension funds that are small and they choose to come together so that they have common service providers. You know, they come together as different pensions, and they have one fund manager, they have one custodian, they have one administrator. So we do manage those, but also have the individual umbrella. The individual umbrella works more like the money market, but the difference is that for this you have to wait a whole year. Interest is declared. So you deposit your funds in the custodian bank, keep depositing, and at the end of the year an audit is done, and the interest that is declared out of the profit that's made that year is then distributed across to those that subscribe within them. So we do have the unit trust, we do have the umbrellas, corporate and individual. We do have the private wealth for those that want to have their funds grown independently. I'm a high net worth, I have my money, since dollars for example, or even shillings, but I don't want it to be managed in a certain way. I do have a specific asset classes that I want it to be invested in, and I want it to be managed separate from the other funds. So we do have that category also, of private wealth.
Okay. Now we're going to go into a short break. When we return, we are talking about the unit trust in particular to encourage people out there. Why would one have to invest in one at ICEA, and what are some of the returns and benefits? Dear viewer, we are still talking to Mr. OWEN KATO from ICEA Lion Asset Managers, and he is here to talk about the unit trust, money market funds, and all these investment opportunities that they as ICEA have for you, our dear viewer. Don't go anywhere, we'll be right back.